Some miscellaneous items for corporate taxable income, just things to memorize, things to be aware of. Ordinary and necessary business expenses can be deducted in the year they are incurred or paid. Compensation for key officers is considered a business expense, but we've got a maximum deduction of $1 million for the CEO, CFO, and the 3 other highest paid employees. This is important, and another reason why CEOs, CFOs, they get paid generally through stock options and other items that are not just a base salary. You'll see generally salaries that are not above $1 million for reasons such as this and for other reasons as well. Bonuses for the taxable year can be deducted if paid by March 15th of the following year. The business interest expense deductions limited to 30% of business income. Now, these items individually, all of themselves, are they individually important? I mean, they're important. Obviously, in a perfect world, you'd memorize everything. But I'd say as you see questions with these items pop up, rank those higher and higher in your list of importance. Yeah, definitely know them here, but apply them as we see questions. The maximum deduction for charitable contributions is 10% of taxable income before specific deductions. This one's very important, number 5 here. Business losses or casualty losses are 100% deductible, with limitations depending on whether the property is partially or fully destroyed. We'll see questions on how that works as well. Startup expenses, organizational costs, and intangibles are subject to specific rules and amortization periods. We'll see this as well for different entity types and how that all works. Generally, if I say the $5,000, 180 months, if you don't know what that means yet, you will by the end of all of this. Business gifts are limited to $25 per person per year. That is also important. We'll see questions how that works. It's $25 per person per year. So again, if I give one gift to one person and 3 gifts to someone else, doesn't matter how many gifts, it's limited to $25 per person per year. Now, business meals are 50% deductible. This is one of the most common things you'll see when it comes to corporations. It's also very common when it comes to differences between book to tax income. That's a permanent difference. However, one thing to note, if you've got 2 exceptions to that, if you go out to the bars, you go out drinking. Now, in reality, do businesses deduct bar tabs if they're taking clients out? Sure, I'm sure that happens. But in reality, in the exam, if the question says, "Oh, the company went out, racked up $1,000 bar tab," that's not going to be deductible at all. It's just going to alcohol, stuff like that. It's going to be generally an unreasonable amount, and for the purpose of the exam, that's not deductible. However, so that's 0% deductible. For 100% deductible, if you have ever experienced working for an accounting firm, which a lot of you may have that experience, shocker, taking the CPA exam, and if you've ever worked, let's say the policy at the firm I worked at, it was if you worked 10 hours or more for the day, you'd be able to get up to $25. And who knows, maybe that's been adjusted for inflation. Obviously, it depends on the city and state as well. But that was in New York. So, New York, you spend $25, you get half a slice of pizza. You had to eat the meal on premises. So you got to expense a meal on behalf of the company. And why do they make such a big deal about having it on premises? Well, because in that case, that business meal would be 100% deductible for the purposes of the company, or in that case, the accounting firm. So if you've got a pizza party, your company's throwing a pizza party and all the food is going directly to the employees, that would be 100% deductible. However, if I am taking a client out and trying to sell them on something and we're having a meal and I'm talking to them, having a business dinner, that's 50%. So understanding the difference there, important. However, the most prevalent of these examples will be the 50% amount. Penalties and illegal activities are not deductible. As such, we'll see these as common book to tax differences, because if cash flows out the door because of some illegal activity or penalty, then you'll see that cash on the income statement as a deduction or an expense, but not for tax purposes. Federal income taxes are not deductible, which makes sense because that's the end number you're calculating. So you're not going to use the amount that you're paying tax on as a deduction to get to that amount. It's kind of a what came first, the chicken or the egg. But other taxes such as federal payroll taxes, state and city income and payroll taxes, and real estate taxes are deductible, as we will see. Now, capital loss deductions can only be used to offset capital gains, and we'll have specific carryback and carry forward rules. We even have a lesson dedicated to that. Lots of great examples, lots of things to be familiar with. Here, we're going to see examples of everything we saw. So this ordinary and necessary business expense, say a company incurs $50,000 in ordinary and necessary business expenses during the year. The entire $50,000 can be deducted. Awesome. Here in this case, let's say a company pays its CEO $1.2 million in compensation. However, here we see that the maximum deductible amount is $1 million, which leaves $200,000 as non-deductible. So we cannot use that as a deduction. Super important. And if something's non-deductible, of course, that will result in a permanent book-to-tax difference. I only make a big deal of that because that is important for the exam as well. Bonuses for the taxable year can be deducted if paid by March 15th of the following year. Here we just see that a company pays $10,000 in bonuses on March 10th of the following year. The full $10,000 is deductible for the previous taxable year, which is essentially just the deadline. As long as you pay it by the deadline, then you can deduct it. The business interest expense deduction limited to 30% of business income. Say a company has business income of $200,000 and business interest expenses of $70,000. The maximum deductible amount is 30% of $200,000, which is $60,000. The remaining $10,000 is not deductible. Charitable contributions, definitely one of the more important ones here. A company has taxable income of $100,000 and makes charitable contributions of $12,000. Here, though, even though they made $12,000 of charitable contributions, the maximum amount is 10% of the taxable income. So 10% of the taxable income is $10,000. As such, the excess $2,000 is not deductible. We will see a lot of items that affect this, such as how does the DRD, the dividends received deduction, affect your taxable income when it comes to this. Little tricks and caveats we'll see as well. So just know that there are other items that affect this. And then business losses or casualty losses are 100% deductible, with limitations depending on whether the property is partially or fully destroyed. Let's say a company experiences a business loss of $30,000 due to a fire. The entire $30,000 loss is deductible, subject to limitations, depending on the property's partial or full destruction. Let's go through and see some more examples based on these other items. We're going to run through some other examples for the startup expenses or costs and intangibles. A company incurs $25,000 in startup expenses. These expenses are subject to specific amortization rules and may be deducted over a period of 180 months. This is something we will dive into for multiple entities for sure. Life insurance premiums and proceeds have different tax treatments depending on the beneficiary. Company pays $5,000 in life insurance premiums for a policy on the CEO with the company as a beneficiary. The premiums not deductible, but the proceeds will not be taxable. Reason being, your CEO drops dead, the IRS figures you have worse things to worry about rather than paying taxes on this money. You probably need it because your company may be in a little bit of disarray. Business gifts being limited to $25 per person per year deduction. We'll see this in action as well. In this case, the company gives business gifts totaling $30 per person to 10 clients. As such, the maximum deductible amount is $25 per person, resulting in a total deduction of $250. Business meals being 50% deductible. A company spends $2,000 on business meals. Only 50% will be deductible, resulting in a $1,000 deduction. Now, keep in mind, if it's internal, such as the company's throwing a pizza party and all of the employees are there, then that would be 100% deductible. If you go out for the purposes of the exam, maybe it's this different in real life. Can't say I've done business returns for a situation with this, but if it says the company went out, spent a bunch on booze, and they went wild, that's not going to be deductible. Going out to the bars, doing something like that. Now, client happy hours are actually deductible, but for the purpose of the exam, if you see anything like frivolous or not related to business like that going on extravagant bar runs, that is not deductible. Penalties and illegal activities are not deductible. This also will result in book-to-tax differences. A company incurs a $5,000 penalty for late payment of taxes. The penalty is not deductible. Federal income taxes are not deductible, but other taxes such as federal payroll taxes, state and city income and payroll taxes, and real estate taxes are deductible. Makes sense because federal income taxes are the end amount that you'll get at. You're not going to be able to deduct that end amount. Company pays $10,000 in federal payroll taxes, $5,000 in state income taxes, and $3,000 in real estate taxes. The company can deduct the full $18,000 for these taxes. And then we have capital loss deductions can only be offset capital gains and have specific carryback and carry forward rules. We'll dive into this also in other corporate lessons. A company has a capital loss of $8,000 and capital gains of $5,000 in a taxable year. The company can use the $5,000 of capital losses to offset the capital gains, resulting in a net capital loss of $3,000, which can be carried forward to future years. Now, how is life insurance treated here? We've got life insurance premiums and proceeds, meaning the amounts you pay for the privilege of having life insurance, and then the proceeds, those dollars coming out of your plan. These are both going to have different tax treatments depending on the beneficiary and the purpose of the insurance policy. We've got two common types of life insurance policies used by corporations: key person insurance and corporate-owned life insurance. Now, independently of the exam, you look at these things and say, wow, am I really interested in this? No, not at all. And maybe you are. I'm not knocking you. But you look at this and you say, wow, is this going to earn me points in the exam and I'm going to pass it and be able to move on in my life and be able to go out, go join happy hours and hang out with my friends? For sure. So that's why we're interested in every topic on this exam so we can get through the exam, move past it, and move on with our lives. First off, key person insurance. Corporations often take out key person insurance policies on the lives of their key executives or employees. So your CEO, your CFO, anyone whose death and loss would have a significant impact on the company's financial stability. The corporation is the owner and beneficiary of the policy. Now that makes sense. Obviously, if you've got someone in a important position in the company and they pass on, that is going to be a big hit to the company. Obviously, we're taking this from the corporate perspective rather than the individual perspective. That is a tragedy. But from the corporate perspective, it is just a bump in the road. But we're trying to make sure that we are able to continue on. Now, generally speaking, the IRS is going to say, oh, yeah, if the corporation is the beneficiary of this policy, the proceeds are usually tax free. The IRS saying, yeah, you just lost your CEO. As long as the corporation is the beneficiary, you're not going to be taxed on that because you went through enough. You're probably going through turmoil as your CEO has just passed away. So you're going to have those as tax free. Whereas the premiums, meaning the amounts you pay to have the privilege of that life insurance, those are going to be non-tax deductible. This is because the IRS considers these as a capital expenditure. I would definitely memorize this. This is important. Comes into play when it comes to book tax differences and also just throughout the exam in general. Now, corporate owned life insurance, COLI, this is a type of life insurance policy taken out by a corporation on the lives of its employees, typically key executives or highly compensated employees. Corporation here is going to be both the owner and the beneficiary of the policy. These policies are often used to fund deferred compensation arrangements or other employee benefits. The premiums here are similar to key person insurance. Premiums paid here are generally not tax deductible. However, let's talk about the proceeds. The death benefit proceeds from a COLI policy are usually received tax-free by the corporation, again with a similar mindset as what we talked about earlier. However, under certain conditions specified by the IRC, gotta love that IRC, the death benefit proceeds may be subject to taxation. In order to avoid taxation on the proceeds, the corporation must comply with specific notice and consent requirements and ensure that the insured employee falls within one of the eligible categories. And these are also going to be our highly compensated individuals, key employees, directors, any of those individuals. Awesome, awesome. Looking good. Moving forward. Now we're going to see a wonderfully crafted example. This is dealing with C Corp taxable income. This is accounting for as much as we could possibly cram onto one slide. A few things you won't see the dividends received deduction applied here, but we're going to see items such as startup expenses, charitable contributions, all of these items, business gifts, meals, the fact that you can't deduct penalties and fines, all of these and how they apply to a sim or multiple choice question. We've even got blatantly labeled unrelated distractor information, so obviously that is not something to worry about. Maybe a question could say, we sold 12,000 widgets and then we sold them for $2 each, so you do that math. But this is widgets produced. I mean, there's nothing really there to indicate this would be useful at all. Here's our process. Obviously, I'll relate to this information as I go through. For calculating our corporate taxable income, first step is what's your gross profit? I mean, that's your first step, no matter what the exam is. Gross profit, first good step. Gross revenue minus cost of goods sold gives us 500. Now, these first three expenses, pretty straightforward. No strange rules or anything there. We're just going to deduct salaries and wages, rent expense, and depreciation. We see those boom, boom, and boom. However, startup expenses, we know that there are certain rules for this. We see that there's a $5,000 limit. You can deduct up to $5,000 right away. And then the remainder, which in this case is going to be $10,000 because total of $15,000. The remainder of $10,000 is amortized over the next 180 months. Starting this month, let's assume this is a clean January to the year end, 12/31 year. We're going to say 10,000 divided by 180 divided by 12. That gives us the amount of expense we can take in this current year in addition to the 5,000. So awesome. Business meals, assuming they are 50% deductible. Again, I would just take note, are these expenses related to taking a client out to dinner, something like that? Business gifts up to the limit. Let's assume there were 100 recipients. So the limit here, so we actually had $5,000 of business gifts, but we can only take up to $2,500. Again, just simplifying it, assuming that all gifts were of equal value. Health insurance premiums and insurance expense, we see their deductions here as well. Awesome. Now we have to calculate our charitable contributions deduction. Like I said, another way to complicate this even further would be to have the DRD deduction in here, but let's take it one step at a time. You'll have plenty of opportunities to practice. Here, we're going to calculate our total taxable income before the charitable contributions deduction, which in this case is $61,500. Then we're going to take that 10% threshold, multiply it by that amount. So this means that we can only deduct $6,150 of charitable contributions, but we see that we had 30,000, being pretty charitable this year, it seems. So the remainder can be carried forward to future tax years, but in this case, the only charitable contributions deduction we could take is $6,150. Here we've got our gross profit minus the total deduction, so we see 500,000 minus 438,500 minus the charitable contributions. That gives us a total taxable income of $55,350. This is a great example because it has a lot of the different tricks and items you'll see throughout the exam and how they all play and relate with each other. Here is the Form 1120, hit the face of it, and just take a good look. It really is a nice big calculation of how we just did what we did on the prior slide. It may help to have this next to you while you're doing calculations such as that. See where you'd plug these numbers in. For me, I'm a very visual person. I like to see this, print it out, have it on another screen, whatever's best for you. This will help, especially also, maybe not as much this because this is just a relatively simple calculation as compared to maybe the separately stated items or individual income taxes. So whichever forms will help you as you're doing your studies, print those out, have them on another screen, whatever it is that will help you.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.